So the Reserve Bank raising interest rates by 75 basis points today. That was expected. And bad news if you're paying off a home or a car. This is the 7th consecutive interest rate hike since the hiking cycle began about a year ago. Since then, the repo rate, which is the benchmark rate that the Reserve Bank uses to lend to commercial banks, has doubled. The prime lending rate affecting most of us, that's gone from 7% to 10.5%. So if you want to know the impact, it's personal. It depends on your debt. But if you look at an average home for 1 million rand on a 20-year bond, that means your repayments could have gone from just under 8,000 rand to just under 10,000 rand. So the jump is 2,000 rand. And obviously, the higher the amount you owe, the more the impact. To discuss, we're joined by SABC News' economics editor, Tshepo Mongoai, and we're also joined by the head of equity at Aluwani Capital Partners, that's Patrick Mathidi. Let me start with you, Tshepo. Let's put this into historical context. Interest rates have been much higher in South Africa's past, but until last year, we had gotten used to those incredible 40-year lows. And over the last year, the hikes have just been relentless.
Absolutely. If you compare with our European counterparts, our interest rates have always been slightly higher compared to what we've always had here. But just a bit of a background. Remember, when we were hit with COVID, we've seen the Reserve Bank on an aggressive rate card to cushion consumers from the impact of that COVID. But obviously, many were still struggling, despite the fact that interest rates were at a record low at the time. But then we've seen that with time, as inflation starts to bite, mainly imported inflation because of developments in Europe, we had to catch up. We've seen with the oil price starting to surge, and as a result, the petrol price also. But that doesn't take away the fact that many of the people are still struggling even now because of the impact of COVID. But then the mandate of the Reserve Bank is to deal with inflation, deal with inflationary pressures and arrest them before they are spread across the economy. So one of the phrases that the government has been using in the past few MPCs is that they have to anchor inflation expectations. In other words, they must make sure that the market and consumer, everyone, prepare themselves for high interest rates. And by so doing, that changes decision, it changes behavior, and eventually will have a lower interest rate environment. And what quite interesting is that globally, we're starting to see inflation starting to come down a little bit. But locally, we have some challenges. Food inflation, we've seen that it remains at around 8%. That's the projections. And in the rest of the world, it's starting to come down. And the governor mentioned the exchange rate, weaker exchange rate. Our rand has weakened, since the beginning of the year. I think he mentioned around 7%. So you could see that we will remain with this current inflationary pressures. Yeah. The other thing is administered prices. If you've been listening, you could tell that there's an appetite to increase this administered prices. It doesn't matter where you look. It could be rail or anywhere else. So that remains a huge threat. And obviously,
Explain administered prices for people who need to know.
Absolutely. Administered prices, these are prices that are regulated by government. Your price of utilities, water, for example, electricity. Those are the prices. You could tell that there is interest to increase those prices. So that means that we could remain with this inflation. The other thing that I thought he will mention in this MPC, in the past he indicated that we could see inflation coming within the target by the second quarter of next year. But it could actually fall within the midpoint of the MPC target only in 2024, in the second quarter. So it's a long way to go.
So they've pushed things out. Let me bring Patrick in here, because I want to talk about those inflation expectations, because Inflation is the reason why the Reserve Bank hikes interest rates. It tries to control inflation. So, Patrick, if you look at the outlook, the bank is saying headline inflation for this year will average about 6.7%. Next year, 5.4%. So like Tshepo was saying, there is some signs that it may come down. I mean, is there any way we can say to consumers, okay, hold on, interest rates will start coming down at this point, or is it still really up in the air because of what's happening globally?
Look, based on how the MPC has behaved previously, they tend to be aggressive on the rate hiking front and then lag or be a bit more conservative when it comes to cutting. So I would suggest then that even though the projections indicate that inflation is coming down, as Tshepo mentions, to about 5.4 or closer to the midpoint by 2024, I think the MPC would rather wait, have inflation comfortably within that target range before they start hiking, sort of cutting. In other words, I don't think they will preemptively cut, excuse me, based on what we've seen them behave in the past.
All right. So Tshepo, we can't say to people, they're going to come down anytime soon. And we can't even say that if you don't have credit, you're in a better position, because inflation affects the poor. In fact, food inflation, the Reserve Bank was saying 8.8%. That is huge. And that affects the poor who spend a larger amount of their income on food.
Absolutely. So it's going to be an uphill battle, although we can say tentatively there are signs that the long to medium term projections indicate that, well, inflation will come down. It will come under control. The drivers of inflation have subsided recently. We've always looked at the international oil price. There is not much pressure coming from there, but internally there are still some risks that perhaps will continue to push up inflation. The wages that workers are demanding, that could also be another source where we could see inflation also remain with us for a prolonged period of time. So those challenges are there, and definitely the bank is not hinting that things will be better, and for obvious reasons, because they really want to make sure that we get the message that things are going to be tough, so that can actually influence our behavior.
And we also need the war in Ukraine to come to an end. We'll talk about consumer behavior, talk about Black Friday a little bit later on. But Patrick, coming back to you, what is the market impact now? Because South Africa has traditionally had better interest rates. That's been attractive for investors coming here. But then, of course, we're now following global central banks that are just hiking after introducing hike after hike after hike.
Yeah, so that's interesting because, from a market's point of view, one of the big questions we ask ourselves, and it's a global question, is to what extent have all these rate hikes had an impact on the real economy and therefore on corporate earnings? So if you look at the US, as an indicator, you can see that, during this past reporting season, not only were earnings reports coming from companies disappointing, but a few have actually started to lay off staff because they can see headwinds coming through. So the impact of rate hikes, so in terms of borrowing costs and affordability, is having an impact on the end consumer and demand. And as a result, they are preemptively cutting labor. So that then becomes, the question on our side as to, will our companies also follow suit? To what extent, have the MPC's rate hikes had an impact, on the company's bottom line in terms of debt affordability? And also coming back to the MPC themselves, you can see that their own growth projections in terms of GDP, for this year, for next year, and also for 2024, they continue to be revised downwards, meaning that, yes, we have inflation, yes, we've got rate hikes coming through, but also we have this challenge of growth still being muted, if not disappointing. Which then also does not bode well, in terms of things like employment opportunities, employment growth, and obviously corporate earnings are going forward. So I think the market, is still sort of trying to figure out to what extent will this have an impact on earnings? And typically it does, for obvious reasons. And therefore the question becomes, to what extent is it priced in? And our view is that, yes, there will be pockets where companies will be able to, be creative, be able to, grow, the earnings going forward. But by and large, we can expect the earnings to come back, and then that will therefore impact, the market returns in terms of expectations going forward.
All right, let's end with that with you, Tshepo. He's right, the expectation has gone from 2% growth, we're now down to 1.8%. It doesn't sound significant, but for this economy, it's huge. What does it mean for the fight against unemployment and poverty in South Africa?
I think the trigger could be the heightened risk of recession. We hear that there's a possibility that many European countries could enter recession. Or yes, the issue of energy has subsided in Europe, but there is a concern. The Reserve Bank is downplaying the issue of recession. They're still optimistic that locally we'll still be able to grow, although at a marginal rate, with around 0.7% in the third quarter and 0.4% in the fourth quarter. And they've not priced in a possibility of a recession. But if you look elsewhere, there are concerns that it could be a reality and the impact could quite be severe on us if indeed that happens. And that would also be inflationary in a way, knowing that the demands would be a bit of a problem for us as emerging economies. So it's a space that we're watching very closely in terms of how will locally lower economic growth eventually affect us. As you correctly pointed out, we are at around 1.8% currently. Even global economic growth has been revised to just below 3%. So you could get the signs that there is not as much optimistic about global economic activity.
Yeah. And I think that's worth highlighting, that South Africa is underperforming compared to the world that's already in the doldrums. Even if we were growing at 2%, the population is growing faster than that. So technically we are becoming poorer and poorer, and that has to change. All right, thank you both. That was Patrick Mathidi, Head of Equity and Balance Funds at Aluwani Capital Partners, and Tshepo Mongoai, our own economics editor here at the SABC.